Market forecasts. The events of the past year have added significant uncertainty to the cyclical economic outlook, as reflected in our own probabilistic projections, which are basically a toss-up between a mild recession at 50% and no recession at 45%. In any event, the era of low rates and easy money is over, and both stocks and bonds merit higher risk premium relative to what prevailed before. Given our growth views and the path for monetary policy, we expect market volatility to persist, especially in the first half of the year. The direction and magnitude of rate moves and ongoing geopolitical frictions should remain key market drivers. In our view, the most important market development for next year is that the correlation between stock prices and bond yields will likely turn positive again, given that the Fed will be able to cut interest rates once a recession begins. To that end, we have raised our fixed income allocations to neutral from underweight for the first time since the early days of the pandemic. Another key theme that we believe will begin to assert itself this year is the end of almost 14 years of U.S. equity outperformance versus the rest of the world. Before we delve further into other important trends for the year, let us go over our scorecard on the market side, just as we did with our macroeconomic projections in the previous section. With respect to market calls from last January, what did we get right in 2022? Three significant ones come to mind immediately. First, on the fixed income side, we correctly recommended that investors should maintain a short duration stance and were positioned for higher bond yields. This one is self-evident, as rates had their worst year in decades, and there is no need to expand this theme further. Second, we also correctly recommended overweighting value factor equities over growth factor equities. We also recommended that investors overweight small caps over large caps. Now, while small caps have not significantly outperformed large caps, their performance has been quite resilient given the extent of global equity market weakness. Finally, we favored investments in the broad commodity complex, and those have proved prescient, as the sector as a whole has been flat to slightly up in a very negative year in other asset classes. Now, perhaps a more interesting question: what did we get wrong? While our overall growth call was right, our neutral positioning on risky assets was too optimistic, and we should have clearly been underweight risk assets within multi-asset portfolios. That being said, we are glad that we reduced our bullish positioning from the previous year in anticipation of volatility, given rich valuations across assets. Two developments contributed to the miss. First, we did not expect core inflation to remain as high as it did for so long, because we thought the supply side and pandemic-related distortions would be unwound more quickly. But most importantly, we did not anticipate the Russian invasion of Ukraine, which clearly exacerbated the inflationary trend. The war obviously raised energy prices for several months following the invasion, and global supply chain pressure indicators stopped falling and rose for a few months. For what it is worth, we did adjust our views once the war began and recommended that investors with low volatility tolerance maintain highly elevated levels of cash in their portfolios back in late February after the invasion. This chart shows our two key market forecasts for the US for 2022 after the Russian invasion of Ukraine. We gave a target range of 3,400 to 3,700 on the S&P 500 and a range of 3.2 to 3.6 on the US 10-year bond. As of December 22nd, when we wrote this report, both values were at 38.22 and 3.67%, just slightly above our target ranges. To the right, you will see our estimates for the end of next year. We have a projected range on the index between 4,100 and 4,300 and 3.4 to 3.65% on the 10-year rate. Now, the far more interesting dynamic in our view is the path that gets us there. If a mild recession begins in 6 months, a 50% chance in our view, then the index is likely to trade lower in the first half of the year and rebound in the second half of the year as the Fed cuts rates. If so, then we may see a retest of the lows we saw back in 2022, when the index traded down to approximately 3,500. This downdraft would be preceded by a significant decline in corporate earnings at a time of higher interest rates. If, however, the recession does not commence next year, perhaps in early 2024, remember 45% odds from our framework, then the market could gain some ground in the beginning of the year, only to give some of it up away later in the latter half of the year. This is why we have titled this quarterly conference call A Tale of Two Halves. Of course, the plot twist would be which of those scenarios plays out, recession in 6 months or recession in a year. Under either scenario, we believe it is not prudent to de-risk further or shift into an underweight stance on risk assets, as the odds we assign to a severe recession in the US are quite low, at only 5%. Only in that worst case situation do we see the index trading all the way down to 3,000 or 3,200. One of the reasons why we think that the time to de-risk has passed is that the recession, if it comes, will be the most anticipated one in history. Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.